Hey, what's up, everybody? My name is Vivienne. I am the business software coach. Today, I will be sharing the video topics on the effects of inventory error. You will need to know why this error happened and ways of fixing them in this video. How can a customer cause an inventory error? What happens to profits if you overestimate the amount of inventory you had at the beginning of a period? And how is inventory of goods related to profit estimations? Inventory error occurs when what one believes is in inventory differs from its actual content. The cause of inventory errors can be attributed to simple mistakes, and that leads to either overstated or understated profits. Today, we are going to share what is the effects that inventory errors can cause in your business. Imagine for a second that you are running a business, trying to figure out how much of what goods you have in stock. Your warehouse managers still uses handwritten notes, and you can't quite make out the difference between 180,000 and 100,000 units. Either way, you're at the risk of having an inventory error. A situation that emerges when what you think you have in inventory doesn't match up with what you actually have. As you can imagine, these are particularly devastating to businesses. In this video, we'll look at two major types of inventory errors, which is overstatements and understatements, as well as learning what's the impacts of an inventory error is on an income statement and a balance sheet. Before we go any further, let's take a look at some of the most common causes of inventory errors. As you can imagine, there are plenty. First of all, you could have simply miscounted. Now, that's not as simple as it sounds. As an addition to share error, there could also be the chance that some units were double counted or simply ignored. Think about it like this. If you have a client who doesn't always pick up their orders on time, then they may end up having the goods counted in your inventory. Other causes for error exist, many of which are much more mundane. Chances are you have to convert between different units, such as pounds to kilograms or gallons to liters. Many organizations have different units of counting difference of goods. A pallet may be used to count some goods but not others. As a result, someone could count pallets when they really should have counted tons. Of these two categories of inventory errors, perhaps the most dangerous to a business is ones that result in overstated profit, where the inventory report states that the company should have made more money than it actually did. These overstated inventory reports can come about in a variety of ways, all of which are errors within inventory. Let's say that you are underestimated the number of goods you started with. Because of these underestimations, you think you bought less units than you actually did, leading to an overstatement of profit. By the same token, thinking that you process more goods over the course of terms could also lead to an inventory error, as you think you have more and more goods moved through inventory. As a result, you will again end up with an overstated profit. While overstated profits are horrible, understated profits are also particularly bad. After all, if you can't keep track of your money, then you are likely very inefficient in other aspects of the business as well. As you might expect, many of these problems are the inverse of the overstated issue from earlier. For example, if you think you have more goods than you actually have at the beginning of a sales terms, you may think that fewer goods have moved through the whole process. That leads to an understatement of profits. Likewise, thinking that you have more goods in stock after a sales period could also lead you to think that you sold less than you did, leading to understated profits. Once an inventory error has been discovered, it has to be corrected on the income statement, if not the balance sheet. Many of the above errors end up being found on the income statements. Annotations must be made to address the error as quickly as possible. Otherwise, as you expect, the error becomes first in the series of dominoes that require later attentions. The good news is, however, that if the owner of the goods is questions accurately find the error and adjust it on other forms, no notations needs to be made on the balance sheets for the accounting periods. Of course, if the error is not found, then the assets will still be shown as either overstated or understated. What's the lesson summary in this video? In this video, we look at the importance of tackling the inventory error. We started by looking at causes of inventory errors from count went wrong to different standards of measurements. We then look at the impact of overstatements and understatements, as well as how each could develop. From there, we saw the impact of inventory errors on standard accounting practice, namely with respect to income statements and balance sheet. That's the end of my sharing in today's video. As always, if you learned something new in this video, please give me a thumbs up and don't forget to subscribe to my channels and turn on the notifications bell. My name is Vivienne and I am a business software coach, and I see you in my next video.